So let's jump into today's deep dive. We're going to be looking at high-growth stocks under $10.
Oh, the potential superstars, huh?
Yeah, exactly. Trying to find some hidden gems. We've got MarketBeat's 7-part slideshow, so
Yeah.
they've given us some analyst ratings. And then we've got some research notes from Nut Stuff.
Awesome.
Yeah. So both of these sources, they've screened for companies that are expected to have earnings growth of at least 10% this year. So
What?
2025.
Yeah.
So that's exciting. So it's not just companies that are, cheap for a reason. They actually have real potential.
Got to separate the wheat from the chaff, as they say.
Yeah, exactly. And then it's also important to think about the backdrop. It's
Yeah.
2025, AI is taking off. Clean energy is top of mind for everyone. And the EV revolution is still going strong. And so,
Absolutely. That's kind of setting the stage for, which companies might thrive and which ones,
yeah,
face some headwinds.
exactly. So trends drive markets, and that's important to keep in mind.
Hmm.
So first up, we have Green Thumb Industries. The ticker symbol is GTBIF. And they are a cannabis. They're in the cannabis space, so
Yeah.
they're a supplier for medical and recreational marijuana.
And what's really interesting about this is the fact that, even though the cannabis market is still kind of navigating this very complex legal landscape, especially here in the U.S. with marijuana being, a Schedule I drug, the growth potential is just massive.
Yeah, it's
We're talking triple the rate of beer and tobacco. Like it's
full. Wow.
it's huge. So,
But is it all hype, or is there real, substance to this growth?
I mean, there are some pretty solid factors driving it. We've got increasing legalization, shifting social attitudes, and, new product categories are emerging all the time, like cannabis-infused beverages, edibles, all of that is pointing to a market with some serious momentum.
Yeah, it's like we're seeing the birth of a whole new industry.
And Green Thumb is, right there at the forefront. And that's reflected, in the analyst outlook, despite these regulatory hurdles, right? They've given GTBIF a strong buy rating, and the consensus price target is $16.50. That represents a potential upside of 146%.
Oh, wow.
Pretty impressive.
Yeah. Okay. On to Kion Group, trading under KGRY. And MarketBeat describes them as like a powerhouse in industrial trucks, automation technologies, and supply chain solutions. And they own brands like Dematic, Linde, and Still.
Wow. So they're right at the intersection of several really powerful trends, right?
Yeah.
The rise of automation, we've got increasingly complex global supply chains, the need for super efficient logistics. They're not just riding one wave, they're riding several at once.
Yeah, so really diversified play on some key areas of growth. But do their financials actually back up the potential?
Absolutely. So they've got really strong fundamentals. Their free cash flow is increasing. Their debt is decreasing. And after a little dip in 2024, their stock's already up almost 27% this year.
Not bad at all. And MarketBeat mentioned that one analyst gave them a price target of 52 euro, which is about $52. And that's a potential upside of over 400%.
Now, of course, a single analyst prediction, you always want to take that with a grain of salt, right? But it just highlights, the optimism surrounding Kion Group and their potential.
Yeah, exactly. Okay, so shifting gears a little bit to a company in the energy sector, Denison Mines. The ticker symbol is DNN, and they are a Canadian uranium miner with a major project in Saskatchewan.
And this is where things get really interesting because this ties directly into the energy demands of this whole AI boom that we're seeing. Uranium, of course, is crucial for nuclear reactors. And, there's a lot of talk about nuclear being this, this clean energy solution to power all these power-hungry data centers that AI relies on.
Yeah,
So,
but the stock performance has been kind of up and down, hasn't it?
yeah, it has. So they were actually performing really well up until late 2024 when they kind of got caught in that broader tech sector downturn. And then there was even more uncertainty after the launch of China's open source LLM, DeepSeek.
Ah, okay.
Yeah. And so this raised all sorts of questions about, the future of AI development and the long-term demand for these data centers. So,
So it seems like a bet on uranium is also a bet on AI continuing to grow.
in a way, yeah.
As we know it today.
As we know it, exactly.
Yeah. So what do the analysts think?
Well, despite all this uncertainty, analysts are actually still maintaining a strong buy rating on Denison Mines.
Interesting.
Yeah, with a price target of $3. Now, that represents a potential upside of 89.2%. So it seems like they believe that the long-term potential of uranium outweighs all this short-term volatility.
Okay, next up we have Hudbay Minerals, trading under HBM. And MarketBeat describes them as primarily a copper miner, but they also extract gold, silver, and molybdenum.
Yeah, molybdenum.
Yeah.
Love that.
I don't know a lot about molybdenum.
You don't? Well, it's often used in like high-strength steel alloys and also to enhance corrosion resistance.
Interesting.
Yeah.
So, what stands out to me about this company is that 89% of their revenue is gold and copper.
Hmm.
So 27% gold and 62% copper. So it gives investors exposure to both of those markets.
And that's such an interesting point you bring up because, their performance is going to be influenced by the trends affecting both metals. Like, gold had a fantastic 2024 while copper lagged behind a little bit. However, projections suggest that copper might actually see some much stronger growth in the coming years.
Ah, interesting. Okay.
Okay.
So they could benefit from both the strength of gold and then also this potential surge in copper demand.
It's a bit of a two-for-one deal.
Yeah, 2 for 1, exactly.
And analysts seem to be on board with that as well because they've given Hudbay Minerals a buy rating with a consensus price target of $11.17, representing a potential upside of 69.3%.
Nice. Okay, now let's take a deep dive into the world of biotech with NFX Life Sciences, or AVXL. And MarketBeat describes them as a small-cap company with a drug candidate, NFX 273, that could be a real game changer.
This is where things get really, really interesting. We're talking about a pre-revenue biopharmaceutical company, and they're targeting some of the most challenging diseases out there: Alzheimer's, Parkinson's, other central nervous system disorders.
Yeah, so if NFX 273 is successful, it could be like a blockbuster drug.
Oh, yeah.
But it's a pre-revenue company, so the risks are very high.
It's that classic high risk, high reward
Yeah.
situation, right?
Yeah.
But what if ANAVEX 273, fails in trials? Can the company recover?
Yeah, that's the big question. Their entire future is riding on this one drug,
And that's something that potential investors really need to think about carefully.
for sure. But there's been a recent positive development. The European Medicines Agency has accepted an application to review ANAVEX 273.
Okay, so definitely a step in the right direction, although, it's not a guarantee of approval. But still, it's enough to fuel the analyst optimism because they've given the stock a buy rating and a consensus price target of $44.
$44, wow. So from its current price, that's a potential upside of over 389%.
Exactly. It really highlights that massive potential. But again, it's crucial to balance that excitement with a realistic assessment of the risks that are inherent in biopharma investing.
For sure. Okay, so let's move on to a company that might be influenced by political winds. We've got Vestas Wind Systems, ticker symbol VWDRY. They are a global leader in wind turbine design, manufacture, installation, and service.
And they've had a really interesting stock performance. It declined towards the end of 2024 due to concerns about the new administration potentially being, less favorable to wind energy.
So even if the underlying business is strong, investor sentiment can be swayed by, perceived political risks.
Oh, absolutely. But here's the interesting twist. Vestas actually recently reported a record high order backlog, and they expect this to drive some pretty significant revenue growth in 2025.
Wow. So the demand for their products is still strong, regardless of what's going on politically.
Absolutely.
Yeah.
Huh?
Are there any other potential catalysts that we should be aware of?
Actually, yes. There's a lot of talk about lower regulatory barriers in the U.S., which could further boost demand for these renewable energy projects.
Yeah. That would put Vestas in a really great spot. Strong demand and a more favorable regulatory environment.
It would, and it seems that analysts are taking notice of that as well, because they've given VWDRY a buy rating, although we don't have a specific price target available, that suggests that it's potentially undervalued.
Yeah, yeah. Okay, our final company for this deep dive, or at least this part of the deep dive, takes us back to the EV space, but with a twist. So we're looking at Aspen Aerogels, ticker symbol ASPN.
Ooh, a twist. I like it. What makes them stand out?
Well, they specialize in industrial installation primarily for lithium-ion batteries.
Yeah.
So they're not making the EVs themselves.
Mhm.
They're actually providing this critical component for the batteries that power them.
So they're a play on the broader EV ecosystem.
Exactly. Yeah.
Yeah.
Clever. But hasn't the recent slowdown in EV demand impacted them at all?
It has. So their stock has been, on this downward trend, and they even had to halt construction on a plant in Georgia due to this, decreased demand.
Oh, wow.
But that suggests that they're being proactive, they're adjusting to market conditions.
Yeah, but here's what's interesting, especially for the long-term investor. ASPN is actually currently trading near 18-month lows. So this could be a buying opportunity for those who believe in the EV market eventually rebounding.
It's a bit of a contrarian play, right? Buying when a company is considered out of favor, that can lead to some pretty significant gains if market sentiment shifts.
Exactly.
Yeah.
And analysts seem to think that a rebound is possible because they've given Aspen Aerogels a moderate buy rating with a consensus price target of $19.11.
Which is a potential upside of almost 150%.
Yeah, that's a lot.
It is. It
Wow.
highlights, those potential rewards. But again, investors need to weigh that against the risks of a continued slowdown in the EV market.
Yeah. Okay. Before we wrap up this first part, I wanted to touch on a success story that was highlighted in Nutstuff's research. So they mentioned Palantir AI.
Ah, yes. The stock that's popped 480% in just 6 months.
Yeah, it's a 480% jump.
Yeah.
It's incredible.
Yeah.
And it just shows you that there are, huge potential rewards, even in this under $10 market.
It is a reminder that, while there are always risks, especially in this segment of the market, the potential rewards can be pretty extraordinary.
Yeah, for sure. Okay, so we've uncovered some pretty intriguing companies, and, they have some serious growth potential. But how do we actually value these companies?
Yeah.
Especially when they're operating in kind of these emerging sectors or they have like limited financial history, traditional metrics, they might not tell the whole story.
Yeah, you're absolutely right. It's where things get a little bit more nuanced, right? You have to be comfortable with a little bit of uncertainty, and you have to be willing to kind of look beyond just the numbers.
Yeah, right.
We're not just like plugging numbers into a spreadsheet or we're trying to understand like the potential for future growth and thinking about these bigger market trends that could really propel these companies forward.
Right. Like take Green Thumb Industries, for example. Their valuation, it's not just about their current financials, it's also about the projected growth of, the entire legal cannabis market, both here in the U.S. and globally. So you're factoring in like the potential for widespread legalization and this continuing cultural shift towards cannabis acceptance.
Exactly. And that applies to a lot of these companies. Denison Mines, with their focus on uranium, they're inherently linked to the growth of nuclear energy, which is influenced by, this global push for clean energy and the ever-increasing energy demands of technologies like AI. Like, it's all interconnected.
It's a chain reaction of trends and influences.
Yeah, you could say that. So, when you're valuing these companies, you have to kind of think like a futurist,
Right.
anticipating how these trends are going to play out and impact a company's long-term prospects.
So how do you balance that though? Like the optimism with realism, because it sounds like a lot of crystal ball gazing.
It's about acknowledging the risks, but
Mhm.
also recognizing the potential for disruptive innovation, right? We're looking for companies that aren't just doing well today, but are also positioned to capitalize on the trends of tomorrow.
So, companies with a strong competitive advantage, a clear vision for the future, and the ability to adapt.
Yeah.
So almost like trying to find those early indicators of success.
And speaking of which, one of the most critical factors in all of this is the quality of the management team.
Yeah, the people at the helm, they can make or break a company.
Absolutely. You want a team that's not just competent, but they're visionary, they're passionate, they're adaptable, they're able to navigate uncertainty and inspire their teams. And this is especially true with, these smaller high growth companies. So it's worth, really researching the management team, looking at their track record, their leadership style.
Yeah, it's almost like you're investing in the people as much as the company itself.
Yeah, you could say that. It's ultimately the people who execute the strategy, they drive innovation, and they determine a company's success.
So it's not just about the numbers. It's about understanding that human element, the driving force behind these companies.
Well put. And that human element, can really be the key differentiator between a company that simply exists and one that thrives.
Okay, so we've identified some promising companies and we've talked about valuation strategies. But let's get practical for a second. How do you actually build a portfolio around these high growth stocks under $10?
Ah, so this is where portfolio construction comes in. And it's not just about picking individual stocks, it's about creating a diversified and balanced portfolio that aligns with your goals and your risk tolerance.
So you're saying even if you're incredibly bullish on a specific company, you wouldn't necessarily put like a huge chunk of your portfolio into that single stock.
No, no, exactly. Especially with these high growth stocks under $10. They tend to be more volatile. So diversification is really, really key. Spread your investments across different sectors, industries, even different asset classes. You might want to balance out those high growth picks with some more, stable blue chip companies or maybe some bonds for added stability.
So it's all about managing risk, while still allowing for potential growth.
Yeah.
Almost like building a resilient ecosystem within your portfolio.
That's a great way to think about it. And even within the realm of, high growth stocks, you still want to diversify across companies and industries. You wouldn't want to overload on just, cannabis stocks or just mining stocks, for example.
Right. And what about position sizing? I know that's something that can be important for managing risk.
It's crucial. Position sizing refers to basically how much capital you're allocating to each individual stock. And with these volatile high growth stocks, it's generally a good idea to limit your position size to something that you're comfortable with. That way, if one particular stock takes a hit, it won't wipe out your entire portfolio.
It's all about finding that balance between, potential reward and acceptable risk.
Exactly. It's not just about, finding the next hot stock. It's about creating this structured portfolio that's built for long-term success and one that's able to kind of weather those inevitable market fluctuations.
Well, it's not just like a set it and forget it kind of thing.
Definitely not. Portfolio construction, it's an ongoing process. It needs regular monitoring, adjustments, rebalancing, just to make sure it's still aligned with your goals and risk tolerance.
It's like tending a garden.
Yeah.
You have to nurture it, make sure it's getting the right care, and then you have to adjust as needed.
Exactly. So, we've explored these individual companies, we've discussed valuation, we've talked about portfolio construction. But before we wrap up this part, I want to reemphasize, the importance of research and due diligence.
Especially with these stocks that are trading at these lower prices.
Absolutely. Investing in any stock requires careful consideration. But it's especially crucial with, these types of companies. You have to understand the business model, the financials, the competitive landscape, and their overall growth prospects. Don't just blindly follow the hype.
Yeah, become an informed investor, not a gambler chasing the latest meme stock.
Well said. And as we move to the final part of our deep dive, let's approach these high growth stocks with both, enthusiasm and a healthy dose of skepticism.
Yeah, it's like we're searching for those companies that are, really on the verge of a breakout, ready to, jump to the next level.
Kind of like being a talent scout,
Yeah.
right? Looking for those hidden gems with the potential to become superstars.
I like that. Um, but speaking of potential, timing seems to play a pretty big role in investment success. So how much emphasis should we really put on trying to, get in at the perfect moment?
That's the million-dollar question, isn't it? And the answer is it's nuanced. It's less about trying to predict the market's every move and more about recognizing those opportune moments based on, company specific developments or shifts in those broader industry trends that we've been talking about.
So less about timing the market and more about, understanding the catalysts that could really drive a stock's performance.
Yeah, exactly. Like look at Anavex Life Sciences, for example. The news that the European Medicines Agency accepted their application to review Anavex 273, that's a significant catalyst.
Yeah, it's a sign that, their drug candidate is moving through the regulatory process. And so that could, lead to eventual approval and a huge boost to their valuation. So it's not just about finding an undervalued company. It's about finding one that's, on the cusp of a potential breakthrough.
Exactly. Being able to kind of recognize those inflection points where a company's narrative is about to change, often for the better.
So it's almost like you're trying to anticipate the next chapter in their story.
And just as a good author plants those seeds of, foreshadowing throughout a story, we as investors, we can look for those subtle hints that suggest that a company is ready to achieve some pretty great things.
That makes a lot of sense. But let's address the elephant in the room when it comes to these high growth stocks under $10. What about the risk? We can't ignore the fact that these companies, they do carry a higher level of risk compared to, those established larger cap companies.
No, you're absolutely right. Investing in high growth under $10 stocks, it's not for the risk averse.
Right.
There's greater potential for volatility, sudden price swings, and even the possibility that some of these companies might fail altogether.
So it's a bit like riding a roller coaster.
Yeah.
You're in for an exciting ride, but there are going to be twists and turns and maybe even a few drops along the way.
Yeah, perfect analogy. And just like you wouldn't get on a roller coaster without, knowing the safety precautions, you shouldn't invest in these companies without understanding the inherent risks.
Right. So what are some key risks that we should keep in mind?
Well, these companies, they often have limited operating history, so it makes it harder to kind of predict future performance, right? They may be reliant on a single product or service, which, makes them more vulnerable to competition or shifts in demand.
Yeah, so if that one product fails, the whole company could be in trouble.
It's a real possibility. And they may also have, weaker financials, with limited cash flow or high levels of debt. And that makes them less stable in turbulent
It's
times.
like building on a shaky foundation.
Mhm.
It might look good for a while, but it's not built to withstand a storm.
Exactly. And lastly, these companies, they're often more susceptible to market manipulation or hype, leading to those artificial price spikes and then sudden crashes.
So, we need to be level-headed, do our research, and not get, caught up in all the hype.
Precisely. Approach these investments with healthy skepticism, a clear understanding of the potential downsides, and a strategy for managing risk.
Despite the risks, there's still something really exciting about investing in these high growth companies. It's that feeling of being on the ground floor of the next big thing.
Oh, I agree. It's the possibility of finding that hidden gem before everyone else catches on. That chance to be a part of a company's journey as it, potentially transforms an industry or even the world.
Yeah, it reminds us that investing is more than just, numbers and charts. It's about stories and possibilities and that potential for growth and transformation.
Well said. It's about participating in that world of innovation and entrepreneurship, being a part of something that could truly make a difference.
All right, so I think we've covered a lot of ground in this deep dive. We've explored the allure of these high growth stocks under $10. We've delved into valuation strategies. We've talked about the risks, and we even touched on how to spot those key moments that could signal a company's future trajectory.
It's been a fascinating exploration, and hopefully our listeners, feel empowered to continue researching this segment of the market.
Yeah, for sure. And as we wrap up, I want to leave you with a question. Of all the companies and trends that
Yeah.
we discussed, which ones, resonated most with you? What further research would you do, before making any investment decisions?
That's a great question to ponder, and it's a reminder that investing is a personal journey. There's no one size fits all approach. Do your homework, trust your instincts, and remember that the most rewarding investments are often the ones that align with your values and your vision for the future. Thanks for joining us on this deep dive. Until next time, happy investing.
Disclaimer. North Breach Limited, Nutstuff Trading Name, is an appointed representative of Messels Limited, which is authorized and regulated by the Financial Conduct Authority. Nutstuff has made every reasonable effort to ensure the information provided in this communication is correct, but Nutstuff makes no representation nor any warranty as to whether the information is accurate, complete, or up to date. To the extent permitted by law, Nutstuff accepts no responsibility for any errors or misstatements, negligent or otherwise. Nutstuff, its associates, officers, or employees may also have interests in the financial instruments referred to in this information by acting in various roles. The information in this media is confidential. If you are not the intended recipient, you are not authorized to use the information in this media in any way. Nutstuff does not guarantee the integrity of any media or attached files. The view or opinions expressed are the author's own and may not reflect the view or opinions of Nutstuff. Electronic communications carried within the Nutstuff system may be monitored.